Thanks for tuning into this earnings conversation with LTTS. It's been a landmark year for them. In the words of Amit Chadha, the annual EBIT margin highest ever at 18.5. Landmark year also because they crossed $1 billion in revenues and 1,000 crore rupees in annual profits as well. And then, in the words of Morgan Stanley, it is resilience in a tough macro climate, considering the kind of guidance that they've given, at least double-digit YOY for FY24. Let's put all of this in perspective with the man himself. He joins us right now, Amit Chadha, to talk about how the quarter went by and how the year ahead could be like. Amit, great having you. Thanks for joining in. Frank opinion, did quarter four turn out just the way you wanted, or do you think you could have done better, save for one or two things?
So I do believe that quarter four was a very good quarter. I mean, I will acknowledge that quarter three was not as good, right? And that's where I think because all the furloughs, everything came together. See, if I step back, I mean, you said it rightly in terms of the marks hit in terms of crossing $1 billion run rate, crossing the 1,000 crore mark, getting to 1170 crores, 1090 patents. So all those marks crossed. Not only that, if you look at it, our CAGR on growth, on profits actually is 18% over 5 years. So it's been consistent, right? We've also acquired our largest acquisition yet. SWC was brought in, and as we look at next year, we are guiding on 20% plus growth, out of which 10% plus will be organic, and the remaining will be SWC as it comes in, right? So if I look at it all in a nutshell, I think it was a perfect quarter. From that standpoint, we've been able to. So if I look at the year again, transportation grew at about 22%. Plant grew at about 16%, IP at about 10%, and the two verticals that didn't do so well, which was medical and high tech, actually turned around in quarter four.
Yeah.
So 7% with medical and about 4% with high tech. So that gives me confidence going into FY24. I can tell you that there's a lot of positives and negatives in the macros, right? As you see it. The way we see it is that spends in energy transition, which then impacts our plant engineering, oil and gas business, as well as our industrial business partly. And then if we look at electrification, which positively impacts our transportation business, as well as part IP, because electrification of devices and instruments is happening as well. Equipment is happening as well. So I see that is one clear tailwind that's been happening, right? Second clear tailwind that I believe is in the digital area, but it's moved from connecting device A to device B to actually deeper stuff like cybersecurity, AI, hyperautomation. There's connectivity and there's compute, right? So those are broadly the parts where money is going. So if people are talking about, for example, people talk about Chat-GPT, yes, there's a lot of software that will go into it, but the kind of compute power that it will require is huge, right? And you can't even imagine so if you look at, if you do the detailing, right? The compute power for 3.5, Chat-GPT 3.5, is about 1,500 GPUs working for 5 to 6 months continuously to do the training on the models. Now, Chat-GPT 4 is 10 times that, right? Because you're moving from, say, training about 175 billion parameters to now training 100 trillion parameters. So the large language models are actually going to require a lot of compute power. And therefore, there is a clear expansion opportunity. We may not be able to spend the capex in India, but what we can definitely do is provide the services to be able to build on the long language models, right? And that, in my view, with the large language models, you will have to create models for auto separately, medical separately, industrial separately, etc. So huge opportunity, if you ask me. So that second area of digital will continue to create tailwinds, right? In fact, one estimate is giving us numbers like digital spend is at about $800 billion, will go to $1.4 trillion by 2026. And the third thing that we are seeing clearly is that a lot of our customers are bothered about costs like nobody's business. There are clients in the Bay Area, there are clients in, for example, parts of Europe that would not want to send stuff to India, and now they're discussing which city in India, right? So that is a positive as we see it. And I believe that all that bodes well for our industry. Again, beginning of the quarter, but we'll see how it pans out. But I'm fairly, shall I say, optimistic.
Which is great to know. And in fact, if I'm not wrong, some of the things that you're mentioning may not have any immediacy to themselves, but will certainly pick up pace as the year goes by, and maybe with a multi-year time horizon, so to say.
Neeraj, if you look at it, again, if you think long term, right? So we're proud to be the number one pure play largest engineering company headquartered in India. But that's not enough, right? I mean, you've got to play on a global basis. Globally,
Yes.
maybe top 10, right? We want to be top 5, right? And if you want to be top 5, you've got to think longer term. And that's why we actually gave guidance yesterday during our call for 2 parts. One, we said 20% plus, right? For FY24, and we also reiterated that we will get to that 1.5 billion run rate in FY25. So we're clearly looking at stuff with a longer term because we continue to make investments. Otherwise, you can't make investments. We filed record patents for ourselves. We continue to make investments in clear areas. We've created, we had created a metaverse BU last year. Now we have created a delivery unit around cyber and another one on AI. And I believe that these will be required as we go forward and start to grow. One reality, the kind of business or the areas we were doing business in 5 years ago, only 40% of that will exist in the next 2 years, or 30%, if you're lucky. So stuff is changing. In fact, one of the things that the biggest thing, and I'm sorry, we'll get back to numbers, but one of the biggest things that has been a differentiator for us is a global engineering academy that is helping us retrain employees on a fast pace so that we can keep pace with change.
Got it. No, don't bother about numbers. This stuff is very good to know, Amit. So lovely talking to you on that. Me being me, I'll come back to numbers, but this is lovely to know.
Absolutely.
I guess what your reiteration around the number for FY25 does is give comfort to the street that your growth is not going to fall off the cliff after FY24, because that's a concern that a lot of people have, not just for you, but for the space at large, that if companies have grown at a good pace for the last 2-3 years, at some point of time, it'll cool off. At least FY25, tak, you are saying that things look okay.
So Neeraj, the way I look at it is, so we actually have projections now into, and I won't bore people in detail, but our aspiration is to go from 1.5 to $2 billion, right? And we are not going to take, so we took about 13 years to get to $1 billion. We are not going to be able to take another 13 years to go to $2 billion. Our board, our chairman, our vice chair have very strong ambitions. LTTS is the expression of engineering and technology of the L&T group to the world. And we take this in a very responsible manner, right? There's a lot of people ambitions, there's a lot of people's emotions, dreams riding on this, and we don't want to let them down, right?
Okay.
So you look at that, and then see, I'll give you an example. 3 years ago, we were working on motors and drives, but we were not working on electric vehicles 3 years ago. We invested, and I compliment the management team at that time, our CEO who was there at that time, he allowed us to be able to go ahead and make the investment, etc. We made clear investments in creating a lab, the EV lab that we created. During the COVID year, we remote inaugurated it, right? Because you still had masks on, etc. 2020. And that's paid out for us, big time. And knock on wood, as I say, it's paid out, right? We invested in 5G labs for device testing. And that's paid out for us. I mean, we announced SWC acquisition on 12th January. I sent a note out to my customers on 12th January itself, and I had feedback from them. By the time we hit February, we had closed 2 orders, one for a 5G rollout in New York City, right? And if we are successful in that, there's a big tail behind that can help us, right? Other projects. And the second one is signing a deal with a telecom infra major to do device development and testing for them around 5G. So you can see that those investments and buying SWC at the right time is what's helping us with that tailwind and taking it forward, right? So I do believe that as long as we are agile, as long as we are able to take our teams along, people along, as long as we create a community with our customers and we keep our ears to the ground, I don't think that we should worry about growth falling off the cliff. Last thing, and I'm going to go back to your numbers after that. See, go back and we'll just talk about the US economy. 2000 to 2010, the US economy grew at a clip of about 1% to almost 1.5 to 3.x% in that period. And then from 2000, after the 2009 crash, then next 10 years, again it grew, but this time between 1.5 and 2.5%, right? Every year. In spite of that, companies like us grew double digit through the process. I'm not saying that, that we were companions of somebody's adversity and etc. and took advantage. Absolutely not. We as a sector chose to take our know-how of technology, our deep technical assets, and our STEM graduates, and we moved in the direction that was required around technology. So the technology spends are changing. In fact, the report that came out says legacy engineering spends will actually go down. So if you are caught in the wrong pocket, yes, you have a problem. But as long as we have our ear to the ground and we validate our bets every year. So we validated the 6 bets that we had taken. And I believe that other than sustainability, that will take a little more time for spends to come to it. The other 5 are absolutely bang on in what is required. In fact, we've been changing. So we are talking up AI, we are talking up cyber now, because we believe that's where things are changing.
Yeah. And Amit, please correct me if I'm wrong, but when I look at the M&A scene in the US as well, industrials is coming up in a big way. The last quarter has seen at least 4 or 5 large mega industrial deals happening, which was not a thing of the past. So is that vertical also showing some signs of promise?
See, there are 2 parts in industrial that I believe will bode well for us as well as our competition, everybody in the industry, right? ER&D, right? One is that they are going a lot more digital with their equipment, their devices that they're selling to their customers. Their customers are demanding it, right? Years ago, I sat in a meeting with the CEO of an industrial company and I asked him that, why don't you create an IoT platform that can help people remotely connect to the plant? And his answer was, I don't want them to, because when I sell my boxes in or my equipment into a plant, I want it to be secure, and connecting it will actually make it insecure. That was the answer. And this is about what, 8, 9 years ago. And look today, and every industrial house is wanting to build a platform where you can connect stuff remotely. Times have changed. So a lot more spends going on in cybersecurity, etc., with all of these, right? And automation, further automation. Second is that I again believe that with M&A, etc., what they're trying to do is they are trying to reduce costs. And so that is again a very sharp, laser sharp focus on that. And that again creates jobs, opportunities for people like us to be able to leverage our India centers, etc., to take it forward.
Got it. Okay. Because you don't have the time.
I do want to say there are issues. So STEMCon is still seeing a little bit of headwinds. And I believe it's about a couple of quarters till it cleans up. Hyperscalers, again, there is a stress in the system. And I believe another couple of quarters before that clears.
Okay. Now, with all of this happening, and because you don't have the time, last one question or last 2 questions maybe. One, your growth of all the CAGR numbers that you've done and the guidance that you've given, plus the fact that you've grown with the last 7 or 8 quarters of having EBIT margins above 18%, show that this is sustainable, profitable growth. You reckon with all the issues around attrition, cost, workforce getting back to office and all of that, and transportation costs moving up, you still be able to grow at the same pace of profitability?
Thank you for asking that. So we are 70% back in office, just so you're aware. We have continued to invest in building spaces. So we built up Mysore already, right? We're building up Bangalore, we're building up Baroda, we're building up Chennai, right? So all that is taken into account because we are not looking at 1 year or 2 years. We're looking at the next 5 years, the next 10 years, the way we would normally do like our parent. So with all that in mind, look, we were at 14.x after COVID hit, and we did a lot to come to, and took about 2 years. So FY22, we were already at 18%, right? A plus 18.4 or 18.5. This year again, we've been at 18.5. In fact, exit rate is 18.7 as far as EBIT is concerned. And this is after record increments, everything. See, what we have is a operational playbook around leveraging freshers, training people, getting a mix of masters and bachelors together, as well as increasing offshoring on an ongoing basis, automating some of the work. We've got our own no-code, low-code platforms that we leverage within the company. All that put together, operationally, organic LTTS will continue to operate at this or slightly higher levels. Composite with SWC, we had earlier said there'll be a BIPS, there's 180 to 200 BIPS drop that we will have immediately, and then we'll come back to similar profitability levels. We have narrowed it down, and we have said we'll only be dropping at that 180 bips at maximum. So we'll be definitely in the 17% ranges. And allow me a little bit of flexibility to say where we'll be in that. So I'm not saying I'll be at 16.99, but I'm not saying I'll be at 17.99, but allow me some flexibility to be able to play this. Integration efforts are full on. In fact, we are pleased and we are actually thankful to the asset as well as the people that are there in Smart World. They've taken the whole change very positively. In fact, I'm heading to Chennai again to see them on Saturday. Beautiful competency, good orders. We just need to make sure we come together as a team and deliver. So everybody's excited, and I do believe that the 17% range is definitely possible, and we'll climb from there.
So last question. There is belief on the street that the outlook that you're giving on these operational metrics would require quote unquote steep execution. You reckon it will be a challenging job, or do you reckon that with the capabilities that you have, you would do it easily?
All I will say is I'm blessed by a very good team, and we've all come together. We have done the planning. As we executed from 14.x after COVID and got to 18.x in 1 year, right? We have a high degree of confidence. Execution is already in progress. In fact, and we've already put in stuff in place. We've got a full team that's been working this thing directly full time. And when I tell you that we will get to 17% and then to 18% from there, I'm absolutely confident we'll do that.
Great. We wish you all the best for that. Lovely talking to you, Amit Chadha. Congratulations. Great guidance too, and have a great year.
Thank you so much.
All right. Viewers, thanks for tuning into this conversation.